In our last video, we did a deep dive into 529 plans and how they serve as a powerhouse for education savings. If you haven't checked it out, I'll put the link in the description below. Today, we are expanding that toolkit. While the 529 is a specialist tool for school, most families need a broader strategy. We are going to look at those other alternatives we mentioned briefly. The custodial accounts, known as UTMAs and UGMAs, and the massive new player on the field, the Section 530A Trump account. With the 2026 tax season in full swing, there is a lot of buzz about this 530A, especially since it's the only account that can net your child a $1,000 welcome to the world gift from the federal government. But remember, the goal here isn't to pick just one. Each of these plans serves a different purpose, and the smartest move for your family is likely layering them into a single, cohesive wealth stack for your kids. Let's break down how they work. Let's start with the custodial accounts. You will see two different acronyms, UGMA and UTMA. They are incredibly similar, but the main difference is what they can hold. The UGMA is the older version and is limited to financial assets like cash, stocks, and bonds. The UTMA is the modern version that allows you to hold almost anything, including real estate, jewelry, or even patents and royalties. If you live in South Carolina or Vermont, you will likely be opening a UGMA, as those states haven't fully adopted the UTMA rules yet. In the rest of the country, the UTMA is the standard. Regardless of which one you use, the tax rules are the same. In a custodial account, the first $1,350 of investment income is typically tax-free for 2026. The next $1,350 is taxed at the child's rate. Anything beyond that total of $2,700 is hit by the kiddie tax, meaning it gets taxed at your higher parental rate. While there are no legal limits on contributions, it is advisable to keep annual deposits below the 2026 gift tax exclusion of $19,000. The biggest advantage here is flexibility. Unlike a 529, you are not restricted to education expenses. If your child wants to start a business, buy a car, or put a down payment on a house at age 25, the custodial accounts are there for them. But there is a massive catch you have to be ready for. This is an irrevocable gift. Once you put money in, it is legally theirs. When they hit the age of majority, which is 18 or 21, depending on where you live, the keys to the kingdom transfer to them. Now, let's deep dive into the Section 530A account, which most people are calling the Trump account. This was introduced by the One Big Beautiful Bill Act in 2025 with one goal: long-term financial security for the next generation. Any U.S. citizen under 18 with a Social Security number is eligible to have an account opened for them. But here is the headline. Children born between January 1st, 2025 and December 31st, 2028 qualify for a $1,000 government seed contribution. Think of it as a welcome to the world gift from the Treasury. To get this $1,000 seed, you have to take action. It is not automatic. For those of you with a baby born in 2025, you are likely seeing the new IRS Form 45 to 47 for the first time during this 2026 tax season. You need to file this form by the April 15th deadline by either attaching it to your annual tax return or by submitting the election directly through the official portal at trumpaccounts.gov. I'll put both links in the description below so you can make sure you're using the verified government sites. The Treasury will begin depositing these funds after July 4th, 2026. Note that the money does not go into your pocket or your bank account. It is a direct deposit into the child's established 530A account. Now for the tax question, is this taxable income? The answer is no. The $1,000 contribution is not taxable income to you or the child when it is deposited. However, the account itself functions like a traditional IRA. That means the original $1,000 and all the growth it earns will be taxed as ordinary income when your child eventually takes the money out in adulthood. So it is tax-deferred rather than tax-free like a Roth, but having $1,000 of free capital compounding for 60 years is still a pretty good head start. Annual contributions are capped at $5,000, with some employers offering up to $2,500 in matching funds. Funds must be invested in U.S.-based index funds and are locked until the child turns 18, when the account functions as a traditional IRA. While 530As offer more flexible usage than 529s, they can be held until retirement. Certain withdrawals, like those for education or a first time home purchase, may avoid the 10% early withdrawal penalty of a traditional IRA. The official portal at trumpaccounts.gov is expected to be fully live for account management by mid 2026. If you want to be ready, you need to make sure your child has their social security number issued and that you have Form 45 to 47 ready for your next filing. Finally, let's do a quick recap on the 529 plan from our previous deep dive. The 529 is a tax-advantaged powerhouse built specifically for education. Unlike a 401k, you fund this with after-tax dollars, so there is no federal deduction. However, check your local rules. Many states offer a juicy state tax deduction or credit just for chipping in. For the gift givers out there, the 2026 rules are very generous. You can contribute up to $19,000 per person this year without even touching your lifetime gift tax exemption. And if you're looking to jumpstart a newborn's account, you can super fund it with up to $95,000 at once by using a 5-year front-loading rule. The secret sauce here is the tax-free growth. As long as that money stays in the account and is used for qualified expenses, you will never pay a dime in capital gains or income tax on the profit at either the federal or state level. And with the One Big Beautiful Bill Act of 2025, those qualified expenses are broader than ever. Starting in 2026, the annual limit for K-12 tuition has doubled to $20,000 per student. Plus, the list of what counts as an expense now officially includes things like tutoring, standardized test fees, and even vocational credentialing. Finally, don't worry about overfunding. Thanks to the Secure 2.0 Act, if your child gets a full scholarship or decides not to go to college, you can roll up to $35,000 of unused funds into the beneficiary's Roth IRA. There are some strict age and income requirements for that rollover, so check out my 529 deep dive video for the full breakdown on how to do that correctly. Now, let's look at the master comparison to see how these stack up line by line. First, the primary goal. The 529 is for education. The UTMA is your everything else funds for things like a first car or a wedding. The 530A is a child IRA built for retirement and long-term wealth. When we look at contribution limits, the 529 and UTMA are virtually unlimited, though you have to watch out for gift tax rules over $19,000. The 530A is strictly capped at $5,000 a year total, which includes anything your employer or grandparents chip in. Next, for all three accounts, the penalty on principal is 0. Because you funded these with after-tax dollars, the IRS does not penalize you for taking back your original cash. The federal penalty on growth, however, is where they differ. In a 529, you pay a 10% penalty on earnings if you don't use it for education. In a UTMA, there is no penalty. In a 530A, once the kid turns 18, it follows standard IRA rules, meaning a 10% penalty on growth if they pull it out before age 59 and a half. Regarding control, the 529 is the only one where the parent keeps the keys forever. In a UTMA, the child gets the money at 18 or 21. In a 530A, the child takes over at 18, but withdrawals are legally prohibited until the year they turn 18. For state tax recapture, this only applies to the 529. If you took a state tax deduction and then didn't use the money for school, your state might ask for that tax money back. The other two don't have this issue. In terms of investments, the 529 gives you a specific menu. The UTMA lets you buy almost anything, even real estate. But the 530A is on a growth leash. Until the child turns 18, you are legally restricted to low-cost U.S. index funds like the S&P 500. No individual stocks or crypto allowed. Finally, the federal seed. This is the welcome to the world gift we've been talking about. The 529 and UTMA offer nothing here. Only the 530A gives you that $1,000 head start from the Treasury for kids born between 2025 and 2028. If your head is spinning from all these acronyms, let's simplify this into a clear priority list. You don't necessarily have to use every single one of these, but you should know where the low-hanging fruit is. First, the immediate win. If you have a child born between 2025 and 2028, Your first move is the Section 530A Trump account. Even if you don't put in another dime, you need to file Form 45 to 47 with your tax return to claim that $1,000 federal seed. That is free money compounding for 60 years. Don't leave it on the table. Second, the education anchor. Keep your 529 plan as your primary vehicle for college. It is the only account that stays 100% in your control forever and offers the best tax-free growth for tuition. Third, the Life Fund. Use the UTMA or UGMA for the everything else if you can and if you need it, buying a first car or starting a business. This is your lifestyle flexibility fund. But as I mentioned in our 529 video, there is one rule that overrides all of this. Your own retirement planning comes first, and your kids' savings come next. You can get a loan for a car or a house, and your kids can get a loan for college, but nobody is going to give you a loan to fund your retirement. Secure your own oxygen mask first so you can be a financial resource for your kids later. I hope this helps you make a smart decision and a calculated investment for your family's future. If you found this breakdown helpful, hit subscribe to join our community of smart planners. You'll get more updates and tips just like this to help you grow your family wealth. Thanks for watching, and I'll see you in the next one.